Hello and welcome to new stocks update video. Stocks fall as rate rises ruffle markets, and retail sales fall short of expectations. And this is what Elon Musk did. Stocks in the United States fell on Thursday as Wall Street digested another significant rate hike by Federal Reserve officials and reviewed comparable moves by monetary regulators across the Atlantic. Consumer spending data that was disappointing also weighed on sentiment. The European Central Bank and the Bank of England raised interest rates by 50 basis points on Thursday morning, following the lead of the Federal Reserve of the United States. Please don't forget to hit the like button for the YouTube algorithm. The Bank of England's increase raised interest rates to their highest level since 2008. The S&P 500, GSPC, fell 2%, while the Dow Jones Industrial Average, DJI, fell 600 points, or 1.8%. The technology-heavy Nasdaq Composite, IXIC, lost 2.3%. Treasury rates in the United States fell somewhat, with the benchmark 10-year note dipping below 3.5%. The U.S. dollar index rose slightly, as oil prices fell, with West Texas Intermediate, WTI, crude futures trading near $76 per barrel. Meanwhile, the government's retail sales report revealed that spending declined substantially in November, as the critical holiday shopping season began. The most recent retail sales figure indicated a 0.6% decrease over the previous month but a 6.5% gain over the same period last year. Black Friday and holiday shopping were unable to preserve retail sales last month, which fell the most this year and fell far short of expectations, Morgan Stanley's head of model portfolio construction Mike Loengart said in a note. The consumer has remained resilient in the face of high inflation and rising rates, but high costs and predictions of a recession may have some second-guessing reaching for their pocketbook, he added. It's been a busy week for investors, with both the Fed and the ECB hiking interest rates, so it's not surprising to see a wobbly market. While a dip in retail spending indicated economic weakness, another data release released early Thursday highlighted persistent labor market pressure. Unemployment insurance claims decreased significantly last week to their lowest level since September. According to Labor Department data, initial jobless claims, the most recent snapshot of the U.S. employment situation, were 211,000 for the week ended December 10, an 11,000 decline from the previous week's corrected estimate. On the business front, Tesla, TSLA, stock held steady Thursday after falling all week, despite a regulatory filing revealing that CEO Elon Musk sold approximately 21,995,000 shares of the company, or around $3.6 billion, during the three-day period ending December 14. Tesla shares are down almost 20% so far in December and about 55% year-to-date, as the electric vehicle giant's sell-off has escalated in recent days. Lennar, shares recovered early losses after the homebuilder reported earnings late Wednesday that indicated an 11% increase in fourth-quarter profit. The swings on Thursday morning mirror drops across the main averages in the previous trading day after the Fed raised its benchmark interest rate by 50 basis points. Fed Chair Jerome Powell also stated that he and his colleagues will continue to raise interest rates in 2023 to an upwardly revised terminal rate of 5.1%. The half-point increase on Wednesday, which raised the Fed funds rate to a range of 4.25%–4.5%, was a deceleration from the 75 basis point increases at the Fed's previous four policy meetings, the most aggressive sequence of hikes since the 1980s. Despite a slowing in the speed and scale of increases, Powell insisted that his and his colleagues' efforts to combat stubbornly high inflation were far from over. Now that we've raised interest rates 425 basis points this year and have entered a restricted area, it's significantly more crucial to consider what the eventual level is. Powell stated this during a press briefing with reporters on Wednesday. At some point, the question will become, how long do we continue to be restrictive? The Fed's dot plot, which shows policymakers' estimates for interest rates, showed expectations for the federal funds rate to rise to between 5.1% and 5.4% in 2023 and to remain at a median rate of 4.1% in 2024, up from a previously estimated 3.9%, a change strategists say is the biggest surprise revision to the central bank's outlook. These estimates are noticeably more hawkish than their previous expectations and were not anticipated well in advance, as is customary with the Fed, William Blair macro analyst Richard DeChazal wrote in a note.